Hello and welcome to another episode of Darwin Investors. All right, we got another big week on the market again, folks. We got the inflation report, which is going to come out on January 12th. And we've also got the beginning of another earnings season. That usually kicks off with the big banks. Now, I'm expecting a lot of positive data to come out this week. So I'm thinking this could be a pretty nice week for the major indices. Now, on this week's show, I'm going to briefly forecast the inflation report before it comes out and just kind of give you the expectations of what's supposed to happen. And I'm also going to discuss how to play this, what I believe is a secular bear market. There's only some sectors are doing just fine. You know, the S&P has been flat since last May. But some have been fine and some have been not so fine. Unfortunately, the ones that have been not so fine are the ones that we tend to gravitate towards. That would be your consumer discretionary and your tech stocks, because these are the companies that we know and love. These are going to be your Apples, your Microsofts, your Starbucks, and that sort of thing. But those aren't the companies that are doing well. And this has been kind of like a slow moving sort of like problem. You know, it's been more like an iceberg. Not so much that we haven't noticed that our stocks are going down, but what we haven't noticed is that the other stocks have been going up. And because of the some are going up and some are going down, our net return has been pretty flat. And the reason for this is because a lot of big money, a lot of the hedge funds are kind of using a recessionary playbook. They're staying away from the sectors that generally don't perform well during a recession, and they're slowly putting their money into sectors that do perform well. Now, I'm going to show you how I'm going to be navigating this market downturn using my own recessionary playbook. And I'm going to continue using this recessionary playbook until the Fed finally decides to U-turn. So let's go ahead and have a look at that inflation forecast. All right, so like we said, the CPI data is due to be released on Thursday, January 12th at 8:30 a.m. Our current year-on-year inflation is sitting at 7.1%. What is forecast is that it's going to go from 7.1% down to 6.7%. Now we're going to break that psychological barrier of 7%, and that I think is going to send the market straight up. It's like, hey, we're finally below 7. The forecast is for 6.7%. However, the consensus is for 6.5%. So when you turn on the TV on Thursday morning and they're saying, hey, what is the expectation for inflation today? It's, from what I understand and what has been happening in the past, they're not going to say that it's 6.7% they're looking for. They're going to be disappointed if it's any number above 6.5%. So what number month on month will get us to 6.5% year over year? So all we have to do is we look over here on this chart, and we're saying that this month divided by this month equals 7.1%. So let me just show you real quick on a calculator what that means. So this 298.349, and if you divide it by November here, 278.524, that gets you to your 7.1%. Now we're trying to get to 6.5%. So now if you take this same exact number, this 298.349, and you divide that number by last December's number, which is 280.126, you're going to see that gets us to our 6.5% consensus. So what they're saying is that if this number is flat, if we grow at 0% month over month, we'll get to 6.5%. Anything more than 0 is going to be a disappointment and could send the market in the other direction. So fingers crossed we get to 0. Now 0 is pretty hard to get. You can see it was going up pretty in a straight line here at 1% in May and 1.3% in June. And then it slowed down quite a bit. The only month we were able to achieve 0 was here in July. But other than that, it's gone up a little bit. So 0 might not happen, but what the forecast for was for 6.7%. I'll just spare you the math. That was 0.1. Okay, so the forecast is for 0.1% increase in December over November, but the consensus is for 0. And unfortunately, we've got to hit this or I'm afraid the market might go down. So that's going to be our inflation forecast for this week. Fingers crossed we get 0. And now let's focus our attentions on whether or not we're in a recession. So at times like this, I like to consult Google the wise. So I typed, are we in a recession into Google? And according to Google, not yet. We haven't quite hit all of the indicators necessary to conclude that we are in a recession right now. According to NerdWallet, and I'm just looking at the headlines here, but according to NerdWallet, although the economy has sputtered in 2022, it certainly has been resilient, and that has been evident in company earnings, and we're going to find that out this week coming up. Those earnings are going to be all right. So yeah, it has been resilient. A recession is defined as a significant decline in economic activity that's spread throughout the economy. Yes, that's true. It's a prolonged economic downturn. Yeah, that's been happening. A significant decline in economic activity that's spread across the economy. Yes, that's happening, as evidenced by our producer price index and our manufacturing index that just came out this past week. It's a sustained contraction of the economy. Yeah, we did have negative growth for 2 straight quarters. However, the GDP did rebound last quarter. But all in all, it depends on who you ask. But one thing is clear, the S&P 500 dropping more than 20% indicates that the S&P, or the only person that I care about more than Mr. Google here, is that the stock market thinks that we're in a recession. And because the stock market thinks that we're in a recession, certain things have been happening. So let's go ahead and look at, say, over the past year here, and we'll look since May. In May of 2022, the S&P was sitting at 3,900. We're currently sitting at 3,895. We're essentially moving sideways. And this is something that I think is going to continue at least through this summer and maybe even a little bit longer. We're going to continue moving sideways, but everything is not moving sideways. All is not as it seems. Now, as we all know, the stock market is broken up into a bunch of different sectors. These sectors include the energy, financials, utilities, industrials, technology, healthcare, discretionary staples, materials. And then there's also some subsectors such as the home builder sector and the metals and mining and semiconductors and things of that nature. But by and large, we're going to keep this to the larger sectors. And when we go back here and we compare the S&P 500 to the individual sectors, we can see that some are performing favorably to the S&P and some are lagging behind. So if we look at energy here and we compare it to energy over, say, the last 6 months, and we know that it's been trading sideways for 6 months, we can see that the S&P is over 6 months down 0.19%, while energy is up 23%. If we further compare this to financials, we can see that the financials are up 10%. In times of recession, the markets makers, they like to gravitate towards energy and financials. They also seem to like industrials, such as, say, Raytheon, Northrop, who else is in there? Lockheed Martin, Boeing, and the like. And so these have been going up, and you might be asking yourself, why does Boeing go up? They lose money. They're a garbage company, right? Well, they're going up because they're part of this sector. So it doesn't matter how good or bad you are, just be part of the sector and you should be okay. You might be asking why John Deere and Caterpillar just continue to go through the roof, even though we're not making anything, like we're not constructing anything. Well, it's because they're part of the industrial sector. Other things that seem to do well here are the metals and mining. That would be the XME. And the XME is up 22%. All of these are your recessionary sectors. Now, let's go ahead and compare that to the ones that do not perform well in a recession. And these are the sectors that we really prefer to own because these are the companies that we know and love. And quite frankly, if you break down the average tech company to the average, say, industrial company, you're getting a much better deal out of the tech. It's like, wait a minute, the net margins are better with tech, the growth is better with tech, the free cash flow is better with tech, the price to earnings ratio is lower with tech than it is, say, in staples. It doesn't matter because it's not part of the recessionary playbook. It continues to suffer. So let's go ahead and look at the ones we like and compare that to the S&P 500. So if we compare the S&P to the XLK, which is the tech sector, over the past 6 months, we're going to see that the tech sector here is down 6%, and the S&P 500 is down 0.19%. We can see that the discretionary sector, which is the XLY, is down 9.76%. Now, this is very important to us because this is where all of the stocks that we like to own are in. And the tech sector, though it's down 6%, it does weigh very heavily on the S&P 500 because it's 30% of all the indices. It's 30% because these companies are making all the money and they're down, which drags it down. But there's a lot of sectors that are sending it upwards. Sectors such as healthcare here at XLV. That's going to send it upwards. It's up 4% relative to the S&P 500. Another sector that might be up, and though we might not understand it, it just is the home builder sector. The home builder sector is mysteriously up 8.92%. And that's because they had low price to earnings ratio and they returned money to their shareholders in the form of dividends. So these are the ones that are looked favorably upon in a recession. But knowing what I know about stock valuations, I'm very reluctant to put my money into some companies that don't have as much free cash flow, don't have as much profit margin, don't have as much growth, and don't have as low a price to earnings ratio as some of these other, like I'm reluctant to take my money out of tech or some of these consumer discretionary names just because we're in a recession, according to the New York Stock Exchange. And so I'm very reluctant to do it. So as a way to get around this, what I've done is I took all my money out and I stuck it all into JEPI. Essentially, I'm just done fighting the Fed at this point. And more important, I'm actually just done fighting the hedge funds and the banks and all the big money and just the New York Stock Exchange in general. I'm just done doing this. But I can't bring myself to go out and buy stuff like Travelers Insurance and Progressive Insurance and Coca-Cola and AbbVie and Merck. I'm just going to go ahead and let JEPI do it, and then I'll collect my 11.5% annual dividend until the Fed does its U-turn, and then I can go back into the companies that I know and love. And what actually did this was this past week, there was a couple of events that actually did this. One was the JOLTS report that came out on Thursday. And what had happened was that it looked like the job market was kind of stronger than people thought. And for this, people feared that the Fed was going to have to keep on cranking up interest rates. And because of this, the stock market sold off. It sold off on a strong JOLTS report. And so, look, I can get behind the stock market selling off because we're trying to bring down inflation and the Fed needs to increase interest rates. I guess I can get behind. I may not like it, but at least I understand it. But what I don't understand is the necessity to run millions of people out of work in order to bring the stock market back. I don't understand that at all. And for that reason, that was one of the reasons that led me to sell my stocks and go into JEPI, because I just can't get on board with putting all these people out of work. I can't wrap my head around this logic of how putting millions of people out of work is going to help the economy. I don't get it. I mean, we're not even fighting inflation anymore. It's like James Bullard comes out, I think it was yesterday, and he was talking about how 2023 is going to be a disinflationary environment, which doesn't mean deflationary. It just means that the price of goods are going to go up a lot less than they did last year. So we're in a disinflationary environment, and we're in a disinflationary environment because the commodity complex is breaking down, because the PPI is rolling over, because the manufacturing index is the lowest it's been since the pandemic in like April of 2020. Yeah, the economy is really slowing down. Inflation is really slowing down. Why are we cranking up interest rates? Oh, it's to drive up unemployment. I'm sorry, I just can't get behind that. I don't understand that. So I'm just going to go this way with JEPI. But that wasn't the only reason that I sold off last week. The next reason was because yesterday's job report came in, and it came in better than expected. And that was because the amount of wages going up wasn't as high as what was projected. It only went up 0.3% year over year. And so they were expecting some number much higher than that. Because it didn't come in as hot as they were expecting, they're like, look, maybe the Fed isn't going to have to turn the screws so much because people aren't making as much money. Although the unemployment rate came in at 3.5%. And that was something that I thought was just going to send the market right down the toilet because God forbid we have low unemployment, right? But it didn't do that. It actually sent the market up, and that's because wage inflation wasn't going up that much. But I did notice that even though the market was going way up, my stocks in particular were not going up. I had tech, I had discretionary. They were not going up. The whole market was going up. My portfolio was going down. The only stock that I had yesterday that was in the green at the beginning of the day when the market was going up was Advanced Auto Parts. And that's because they pay a 4% annual dividend. And that's why that one was going up. Other than that, the rest were going down. And I took this as a sign, same as I did in February 2021. In February 2021, I was completely, I'm a gambler. If you watch this video, I'm a gambler. So I took my money out of my responsible value stocks and I was sticking them all in SPACs and growth and stuff like that. Because, I wanted to ride the wave. I want all the money. I made plenty of money. But in February 2021, all the SPACs and those kind of growth companies started going down and the value companies were going up. So I noticed when the market was going up, all my portfolios going down. That was a sign to me that it was time to sell. And that's what happened yesterday. The whole market was going up, but my portfolio was going down. It was a big indicator to me it was time to sell. So I sold my stocks and went into JEPI. And I wasn't sure if I did the right thing or wrong thing. And I was pretty happy to find out that over lunch, it was a show called Halftime Report with Scott Wapner, who, by the way, is awesome. He was doing this show and he was interviewing this Bryn Talkington. And then when I saw what he was asking her, one, she said she was going to do what I was going to do last week with Tesla. She's doing it right now. I might still do it in the future. Check out my last video to find out what I was going to do with Tesla. But also she was talking about her recession plays for 2023. Let's check out this video and see what she had to say.
All right, so let's go through these. And we mostly have had individual stocks. You're playing in a different way. In some ways, people will remember some of the things you've talked about before. The JEPI is number one. Refresher, why is that number one? Tell people what exactly it is.
It's number one because it's our biggest position. So we'll start with that. So JEPI at the high level owns about 120 high quality names and then sells S&P calls against that. So it's a covered call strategy. And we added the portfolio, added a small piece in late 2020. We've continuing to add more, and right now I guess it's a little bit over a third of our portfolio. Last year that strategy was down 3.5%. The S&P was down 18, the Barclays Ag was down 13. So when you ask me what do I have the most conviction in, it's still JEPI, and here's why. Is that not only does it have a covered call strategy, but what we really like about it is that they have sector caps where each sector cannot be more than 17.5%. So at the end of 2020, when we were wanting to add it, we were actually trying to reduce tech, right, which was close to 30% of the S&P. So if this strategy is capped at 17.5, we just naturally knew we would take down that tech weighting. Right now, that tech exposure is about 10%, and you have more healthcare and staples and some other strategies. So we think that it's the right strategy at the right time. Right now, the distribution yield, which is a mixture of the dividend and the covered called, is a little over 11.5%, which is paid monthly. So to me, it's a no-brainer for this year.
Okay, number two, the Pacer U.S. Cash Cows ETF, the COWS, COWZ.
Right, so this is the smallest of the three. This is something we started adding last month. Let me explain what it does. As we've talked about, if you look at the analysts this year for 2023, I think the low end is 3,400, and maybe Tom Lee's at 4,750. You could drive a truck through it. And so there's a wide range of outcomes, but we want to be invested. And so what Pacer does is every month, this strategy will come out. So next month, it'll be PFEB for February. So this is just PJAN. It comes out the first day of January, or the first trading day. It gives you a hard floor of a 15% downside. So the first trading day, you were at the SPY of 382. Okay, so 3820 on the S&P. It goes for 1 year. They do S&P options inside of that. It's a very plain vanilla strategy. So at the end of the year, which this will be up, if the S&P is above 30, let's say the S&P is at 3,400, this strategy will be worth 3820 because I have hard protection to 3250 on the downside. On the upside, because volatility is high and they're selling options, this strategy has an upside of 18.5%. So I have upside participation of 4530.
And downside protection.
And downside. So right, so to me in a year with a wide range of outcomes, I want to be invested. I love being able to tell our clients, hey, at the end of the year, you know the range of your outcomes and you're still invested.
Okay. Lastly, and this is new, is the Innovator U.S. Equity Power Buffer ETF, the PJAN.
Oh, that's the one I just did. COWS is the last one.
Oh, COWS is the last one.
PJAN is the one I just walked through.
That's the one you just did.
That's the one I just walked through.
Oh, so tell me the COWS then.
Yeah, so COWS has been in the strategy for a while. And I think if you listen to Lee Cooperman, listen to Jim, Jenny, Rob, it's all about free cash flow. And we want to buy companies that have high free cash flow. And so what this ETF does is it takes the 100 highest free cash flowing yielding companies in the Russell 1000, and it weights them not by market cap, but by free cash flow yield. And so what you end up with is, well, first of all, last year it was actually up 20 basis points, which is not surprising because these are the companies that have the highest free cash flow. And why is free cash flow important for those who don't, for the viewers that don't follow that? When you get free cash flow, what can you do? Dividends, buybacks, M&A, you have optionality. And we want our clients and our portfolio to have optionality, but to be invested.
Okay.
And so we think just those three together give our clients a good yield. You're invested, but you own great companies with a high free cash flow yield.
Is it my imagination, or did she just get sexier? Rhetorical question. The answer is, of course, yes. Okay, so let's go ahead and look at her suggestions that she had. The first one up here is JEPI. It's, of course, the one that I'm all invested in. Now, of course, I have that, plus I have cash. You know, it's like I'm not going totally into JEPI. It's that plus cash, but it's the only stock or ETF or whatever that I own at the moment. I'm going to use my cash to do some trades and try and make a little bit of money because, you know, at the very heart, I am essentially a gambler. But it has an annual distribution yield of 11.68%. It's distributed monthly. This past month, it was given out 57 cents per share. And in the last 2 months before that, it was 61 cents per share. These dividends are paid out because of their covered call strategy and because of the fact that volatility is very high right now. This pays a very high dividend. So for the moment, this is paying 11.68% annual dividend income. However, when volatility comes down, you can expect this number to come down to about 6 to 8%. But right now, this is a fantastic place to put your money. Let's see how much $100,000 would pay you out on a monthly basis, given that you have 57 cents per share right now. So let's grab the calculator and we'll show that $100,000, and you divide that by $55.18, that would give you $1,812 of JEPI. You multiply that by 57 cents, you're going to see that your monthly payout for JEPI would be $1,032. And this is a company that's actually doing all of the dirty work for you, because if you look at these dividends here, or excuse me, their holdings here, you can see that they're holding on to AbbVie, Progressive, Exxon, United Health, Coca-Cola, Hershey's, Pepsi, Bristol Myers, Honeywell, and Travelers. About 90% of those are some that we would not want to ever hold. The rest are, they have a total of 110 holdings in the ETF, but they also have 15 matches or 15 holdings of S&P 500 covered calls. This is the reason why they're able to pay out such a nice dividend. Let me quickly just review what a covered call is real quick. Let's say you own Tesla and it's sitting here at $113. Then you go ahead and you select call. Today is January 7th. We're saying that by January 13th, if Tesla is above, say, $115, then you agree to sell all your shares for $115 a share. For this right, someone's going to pay you $4.03 a share, or $403 for 100 shares. Every contract is 100 shares. So if Tesla goes to $125, you still have to sell them all for $115. However, if Tesla goes down to $103, you get to keep all your shares of Tesla and their $403. And that's the agreement that you're making with the buyer. And that's what a covered call is. JEPI has a covered call strategy. So it's the reason why they're able to pay out such a healthy dividend. They're basically making money on the S&P 500 because things are very volatile right now. They're giving you some and they're keeping some, and that's the reason why they're able to pay out this dividend. But additionally, they're buying a lot of the stocks that, quite frankly, I don't feel like buying. Because let's look at some of these stocks. Let's look at PepsiCo and let's compare that to, say, Microsoft. PepsiCo is, let's see, $181. It went up $4 yesterday. Its price to earnings ratio is 25 with a forward PE of 26. Its dividend right now is 2.5%. Its growth is 8%, and its net profit is 11.8%. Let's compare this to, say, Microsoft, which everyone loves to beat up Microsoft because it's tech, so it's overvalued. So let's go ahead and compare Pepsi to Microsoft. Remember, Pepsi was like 27 and 29 or something percent price to earnings ratio. Let's see. Microsoft is a 24, and it's actually a growing company, unlike Pepsi, which is shrinking. However, Pepsi is the one people love, and Microsoft's the one people love to hate. It does pay a dividend. It's 1.21%. It's got a profit margin that's 4 times that of Pepsi, and it's got a growth margin which is 4 times that of Pepsi again. Yet this is the one people are steering clear of because this is the expensive one. This is the terrible one. So we're going to go ahead and pile into Pepsi. And because I can't bring myself to do that, knowing what I know about value investing, I'm just going to let JEPI do this for me because, for God's sake, I cannot part with the money to do something that stupid. But they're willing to do it, so I'll put it in them, and then I'll go ahead and benefits. In the meantime, I'll grab this 11.68%, and eventually I'll go back into Microsoft when the Fed decides to U-turn and people come to their senses. So let's move on to the next one. The next one here is Cows. Cows is an ETF that basically specializes in companies that have a lot of free cash flow, as she said in that little clip. Free cash flow is very important to a lot of investors. That's how they base on what they're going to invest in. It's what Leon Cooperman does. He loves free cash flow. Cows is trading for $47.44 a share. It's rated 5 stars over 3-year, 5-year, and currently by Morningstar. It pays a distribution yield of 1.96% annual. It is paid out quarterly. If we look at it over the course of 3 years, it's up 50%. So, man, that's a pretty nice stock, honestly. Leon Cooperman, believe it or not, knows what he's talking about. What stocks are in Cows? Who gives you the most free cash flow? Well, we're looking at Pfizer, Exxon, Valero, Chevron, Dow, Marathon, Moderna, Lion, Philips, and Altria. By the way, when I sold Moderna, that really hurt. I'm gonna have to buy that one back fairly soon because this one trades at a price to earnings ratio of about 5. And honestly, when they come up with their cancer vaccine, that stock's going to the moon. All right. And then the last one that she mentioned is something that I'd actually never heard of. And that was this thing called a buffered ETF. And that was PJAN. And PJAN is something that will switch in February to become PFEB. And what this is called a buffered ETF. And what this does is it buffers whether or not how much money you lose, but also how much money you make. And so she said that most people feel like the S&P is going to finish out over the course of a year between 4,000 and 4,700. This thing will allow you to make up to S&P 4,500. However, it captures losses at 3,800. So even if the S&P goes down to 3,200, this thing will buffer your losses at S&P 3825. And that's what makes this very nice for a large hedge fund such as the one that Bryn Talkington might actually be running. And so she likes the idea of offering her clients these buffered ETFs that limit their downside, although they limit their upside. And limiting their upside is I think a lot of people think is that this year is not such a big deal because a lot of people don't think it's going to go up that much. So why not limit your upside? Because you're not going to hit it anyway. And that's what a buffer ETF does. So let's see how this thing has performed, say, over the last 3 years. So it's down 3 points. It's been up 10%. It's not terrible. I think this is a very situational ETF. This is the sort of thing that is good this year because I don't think a lot of people are expecting a huge year out of the stock market. And if we do have a huge year, it's going to be a huge year to the downside. So this buffered ETF is a way to sort of hedge your losses. And I don't think it's a bad idea. I don't like it as much as Cows, and I certainly don't like it as much as JEPI. Well, that's going to do it for today. I actually had a lot more to say, and I had a whole nother section too, but I understand the way these YouTubes work, and I do value your time. I thank you for checking out the video this week. If you got anything out of this yet, please like, subscribe, hit that little notification bell. Until then, I have a sponsor video to give you, and then have a great day. Bye. Guys, have you ever had a YouTube channel where the people that follow you never troll you and you genuinely do like them? Man, I have. And for them, I give you a little bit of a toast from my sponsor this week, which is beer. Well, I don't know if it's just the beer talking. However, I am a beverage fermented from malt and flavored with hops. I do love ya. And this week's beer is actually Lagunitas IPA, a beer that I definitely do love. And I'm going to have to give this beer 5 Cape Roonies out of 5. Have a great weekend, everybody. Bye.